Welcome to Manager EDU. Today, I will teach you the times interest earned ratio, which is also called the interest coverage ratio. I will define the ratio, teach you its formula, walk through an example, and then clear your concept about how it works and what the value means. So let's start. Times interest earned ratio assesses a company's ability to meet its interest payment obligations on its outstanding debt. When a company takes a loan from banks or other sources, it has to pay interest on that loan. This interest is paid from the profit the company earns. If the times interest earned ratio is higher, it is a good sign for the company because it means the company's profit comfortably covers its interest expenses. If the ratio is lower, it is not a good sign because it means the company's profit may not fully cover its interest payments. Now, before we go to the formula, let's understand what EBIT means. EBIT is part of the income statement. In an income statement, we start with revenue. Then we deduct cost of goods sold from revenue and we get gross profit. Then we deduct operating expenses from gross profit and we get EBIT. EBIT stands for earnings before interest and taxes. It is called that because we have not yet deducted interest expenses and taxes from the profit. After we deduct interest and taxes from EBIT, we get net profit. Now let's come to the formula. Times interest earned ratio equals EBIT divided by interest expense. Here, interest expense is the extra amount we pay on the principal amount of loan. Let's take an example to understand this. Suppose a company has the following income statement for the year. Revenue, $1 million. Cost of goods sold, $400,000. So, gross profit equals $1 million minus $400,000, which equals $600,000. Then, operating expenses are $100,000. So, EBIT equals gross profit, $600,000, minus operating expenses, $100,000, which equals $500,000. Now, then, interest expense is $50,000. And taxes are $100,000. So net profit equals $500,000 minus $50,000 minus $100,000, which equals $350,000. Now we apply the times interest earned formula. EBIT, $500,000, divided by interest expense, $50,000. When we calculate it, so the times interest earned ratio in this example is 10. Now, what does the value 10 mean for the company? It means that the company's operating profit, EBIT, is 10 times greater than its interest expense. Using the graph, you can see that for every $1 of interest expense the company needs to pay, it has $10 of profit available to cover that interest payment. This shows that the company is in a very safe position to meet its interest obligations. If the ratio were lower, say below 1 or 2, it would indicate that the company is struggling to generate enough profit to pay its interest. That was all about the times interest earned ratio. If you didn't fully understand, you can watch this video again. Thanks for watching.